Welcome back to another episode of the Strive for 25 podcast. I've got an amazing guest on today, Chris Miles, the founder, owner of Money Ripples podcast, platforms, income, all the stuff. Cannot wait to dig in today. Because again, we're in this weird time. Inflation's high, people are struggling to pay the bills. Income, passive income is also a main hot topic. So, Chris, thank you so much for making time today.
Hey, it's my pleasure, Joel. I'm really glad to be here.
So, just to kind of give the listeners a little bit of a background on what you do, how would you explain your platform and what you do?
Yeah, you mean like being the anti-financial advisor,
Pretty,
that kind
pretty
of thing?
much.
Yeah. So pretty much I preach against people doing things with financial advisors, right? Who are just AKA salesmen in suits. And the reason I know that is because I used to be one. I used to be a financial advisor back in the day. My parents didn't teach me a lot about money other than just save a lot of it, be cheap, save everything you can, then hopefully someday you'll have something. And well, becoming a financial advisor is like exactly what they teach. They teach you to sacrifice, suffer, spend nothing, save everything, sacrifice, and hopefully someday you'll eventually have something significant, right? Well, I realized after several years of doing that, it wasn't working. I realized that was specifically when I met with my dad. I sat down with my dad because he asked me. He said, "Chris, when do you become my financial advisor?" And I didn't expect this because my dad was very guarded about his money. But I sat down with him and I said, Dad, I mean, even though you're debt free, you paid off your house early, you've been stuffing your 401k. If you want to retire right now at 61 years old, you better hope you die in 5 years because that's how long it'll be before you run out of money. And he said, Well, what else can I do? I said, I don't know. You did everything right, according to what I teach as a financial advisor. And that got me on a journey trying to find what actually works. I like evidence. I like to know that things worked. And I found out later as I started meeting guys that are like in real estate investing and things like that, is that you could actually create enough passive income to be able to retire much sooner than later, to actually do what Robert Kiyosaki talks about in Rich Dad Poor Dad. You can actually do that. And in fact, I was able to do that in my own life. Just the next year after I was meeting with my dad, I did it for myself. I was 28 years old, able to retire. And then of course everyone wants to know how you did it, and that's kind of what pulled me out of retirement in 2007 to teach people how to get themselves out of the rat race and how to truly be, work optional, where you work because you want to, not because you have to.
Okay, so backing up to that conversation with your dad, done everything
Mhm.
right, no mortgage, no debt, got a 401k and not enough. Um, again, time, right, changes the value of dollars because of inflation, but like how
Mhm.
much was not enough? How much did he have if you're okay sharing that wasn't enough?
Yeah, at that time he had about $300,000 and a paid off house, right? It's interesting because everybody talks about, oh, I got to get to 500,000 or $1 million, but really, how long does that really last? Especially in today's day, right? I mean, that was even more back then, 15, 20 years ago. Today, that's nothing. And in fact, Fidelity, they came out of their statistics. They have 45 million clients. And of those accounts, only 750,000 people, or about 1.5%, have $1 million or more. Well, what's interesting is that Transamerica did a study just this year as well that said of those with $1 million or more in their retirement accounts, 35% believe it'll, quote, take a miracle to be able to retire, end quote. So think about it. Like if you're the lucky 1.5% that actually have $1 million by retirement, right? And then even then, a third don't think they'll last enough because why? Because the financial advisor will tell you, at least if they're up to speed with what's going on right now, to only pull out maybe 3% a year. So if you have $1 million saved up, that means you live on $30,000 a year, 2,500 a month. That's just not enough, right? Like, come on, you live in the state of California, you're basically homeless at that, right? So it's just not good. And that's why there's a third of those people that think it'll take a miracle to retire because they realize when they get the real numbers and the real life scenario, they say, oh, my financial advisor made it sound like it was way better, but it's not. And that's for a few reasons. One, because the stock market doesn't return as much as people say it does. It only averages less than 8%, not 12. And then two, because there is inflation, like you mentioned, right? Even conservative inflation, they're saying, well, you better not pull out more than 3% because people are living longer. So that will ensure that you shouldn't run out of money as long as the market doesn't completely crash on you, right? And so you think about that, it really, I mean, somebody wants to even a 100,000 a year lifestyle, you got to have 3 1/3 million saved up. That's just really, really hard to do, especially when the market doesn't return as much as people think.
So you said over 3 million would be an example
Yeah.
of then that taking out the 3% to get to 100,000, or what was the number?
Yeah. Yeah.
Okay.
You need to have about 3 1/3 million to pull out 100,000 a year. And
Okay.
most people I talk to, when I ask them, what is it that you'd like to have in passive income? Most usually say at least 10,000 bucks a month. That's 120,000 a year. That means you
Yeah.
need to have at least $3.6 million in your 401k or mutual funds. And you do the math, you won't be able to save up enough in a 401k, even with the match, to even
Mhm.
get to 3.6 million very easily. I mean, you can max fund it for years and years. You'd probably be going 40 plus years to finally get to that number.
Okay. I mean, now you got me all doom and gloom here. So,
Oh, and by the way, if it takes you 40 years, that doesn't factor in inflation, right? Because
right.
you want
Because
you want 10,000 a month today, but that's not going to be 10,000 a month in 40 years. Is not going to be worth 10,000 a month, is it?
no, it's not. And like, there's one question I want to ask you that revolves around a Patrick Bet David video. Maybe you've seen, maybe you haven't. Talking about a reverse crash and if they lower rates and prices going up and up and up, comparing it to some other countries and hyperinflation or whatever. But
Mm,
I want to back up 1 second. You mentioned, a lot of people talk about 10 to 11, 12% for stock market returns, and you said more like 8%. Can you explain more about
yeah.
that?
Yeah. So the S&P 500, if you look at the last 30 years and you actually take the real rate of return, right? The real rate of return is actually about 7.75%, almost 7.8 right now with the market going up as of last week. But yeah, it's about a 7.75% return, not 10 and not 12. And if you don't think that's much, a lot of financial advisors really talk a lot about the compounding interest and the rule of 72, right? So you want to see how long it takes for your money to double, just take that interest rate divided by 72, and that's how many years it takes, right? So if you get a 2% return on your savings account, it'll take 36 years to double. But if you get 12% return on that mutual fund or whatever, then it only doubles every 6 years, right? Well, think about it in reverse. If you're actually earning, let's say, 4% less than what you thought, because Dave Ramsey told you the stock market always returns 12% or better, which is crap. Never has been the case. But say you believe that, well, that 4%, that, remember, that rule of 72 means that it doubles every now, what is that, 18 years? Right? Yeah. Yeah. Every 18 years, right? So that means if you got 36 years, that means you have a quarter of the money you thought you would have had because of compounding not as quickly. So if you thought you're going to have $1 million by saving and making 12%, guess what? You're going to have close to $250,000,
Mhm.
way, way less in that, that 30 to 40 year time frame. So that's one of the biggest problems. And by the way, most funds don't even get those kind of market returns of the S&P. So if the S&P were more than 90% don't even get that 7.75%, that means you're even earning less. And that does include they take out fees from it. Like if you have a 401k, most people do those target date retirement funds. I found out when I started to look at it, those target date funds were doing 2% worse than the stock market. And on top of that, there's a 0.75% fee, which means you're earning almost 3% less than the stock market in that 401k with Fidelity, right? So the problem is that people are like hoping and praying they make 5% a year in a freaking 401k, and then they get the match, and the match really only adds about a 1 or 2% return long term. So even if it's a 100% match. So people are like, wait a minute, I'm not even earning stock market returns because of this crappy 401k. Well, that's right, because you were sold a bill of goods by a bunch of financial institutions and those advisors that work for them that say this is the thing to do when it still has yet to be proven to really, truly work. Because I guarantee there's more than 1.5% of people out there with Fidelity that are good savers, right? I'm pretty positive that if you even have a Fidelity 401k, you're already a saver, but you're just not saving enough, right? That's bull. And kind of give it a real life application here. There was a guy that he listened to our podcast. We have a Money Ripples podcast, and as he was listening to us, he said, "You know what? I want passive income," because he was at the point of retiring for the military and had $1 million saved up. So he was lucky enough to have $1 million. And in fact, he actually timed the market perfectly for the last couple crashes. He happened to pull his money away from the market right before it crashed. So he even beat the odds and beat the returns of his 401k, right? Well, he went to his financial advisor, and the financial advisor said, "Yeah, well, if you want to pull off income off of this, you better just pull off 30,000 a year." He says, that's ridiculous. I can't live on 30,000. Well, after he heard our podcast, and then he started doing other alternative investments, things like in the real estate side, where you have real assets backing it up and getting paid, different returns. And it's not just rental real estate. He had things with oil and gas. He had things in like apartment building ownership and things like that. His million wasn't paying him 30,000 a year. Now is generating 130,000 a year of income without touching his money, without touching his $1 million. That's the difference. That was the thing that I woke up to that got me to quit being a financial advisor, because when I realized not just that financial advisor wasn't working, but that it was always about, how do I generate passive income from the money that I have? How do I get it to work harder for me so I don't have to work so hard for it? It was like a light bulb went on and life got easier. So that's the primary difference.
So you mentioned alternative investments. You mentioned real estate, oil and gas, apartment buildings. How do you tap into those? What do you guys actually do with those types of vehicles to get people into them, and how does that work?
Yeah, with our clients, we actually like connect them with deals. We don't act as investment advisors. We never claim to be, although we do help people figure out where they can find and free up the money, how they can get their money out of prison essentially, and then get it to work for them in these different investments. And we have like over 20 different operators of people that we've vetted over the years that have actually been around quite a while. Like they've actually, they've been around since like the last recession. They've been investing and learned from those hard times, so that even going into these next recessions, they don't feel as scared about it, right? They're not as green or inexperienced. So we help them kind of match make them up a little bit that way, and help them figure out what are some of the better deals to do. And so they can vary anywhere from like turnkey rentals, where you actually own the property, but you don't manage the property. Somebody else deals with the tenants, the toilets, and the trash, right? You can be hands off, and you can invest anywhere in the country because of that reason. So you can have property managers in those areas where you can be out here. Like I've got properties in Alabama, North Carolina, and Tennessee, for example, places like that where I have property managers doing all the work for me, and then I get paid the profits. I mentioned like apartment syndication is an example. Like syndication is where you can pool your money with other investors to go tackle a big project. Because, for example, most of us don't have the money to buy an apartment building, especially if it has like 100, 200, 500 units. We don't have that much money. But if you pool your money with other investors, then you get a piece of that ownership and you get a piece of the profits, right? So you can do things like that. Self-storage units is another one that's more recession resistant, even though it's been having a rough time like apartments have in the last year. That's another option. I mentioned like oil and gas where you actually lease the land to the oil companies and they pay you royalties. That's the key difference. Not like speculative drilling that a lot of people talk about. Stay away from that more. Even car washes, like you can invest in businesses like car washes and franchises like that, where you can get paid on the profits, as well. So not to mention lending your money and be the bank, especially as banks are charging more interest, you can lend your money to other investors. They'll pay you 10, 11, 12+% for borrowing your money, because they don't have to go through the stupid banks and, go through that whole process, all that red tape. So there's just so many ways when you start to realize how big of this world actually is and how many options there really are, you start to realize that financial advisors are very close-minded. And the reason is because they're licensed to be that way. Because I'll tell you, even when I had my securities license to sell mutual funds, they would not let me get into deals like this. They would say, oh no, you got to clear it with our company first before you can even get into a business partnership. What am I, 12 years old? Like asking my parents for permission for everything? But that's what they make you do. They literally they don't give you a license to be a financial expert. They give financial advisors licenses to sell products. That's what it really is. They really are just salespeople in suits. And to try to open up this whole alternative world, even if they want to do it, many times they can't, because those companies won't let them. That to me is a disservice, because what I'm talking about here, the stuff that I've been doing, this has been proven to work for years, made more millionaires by far than people that have been trying to scrimp and save into these mutual funds and 401ks.
So let's just say you take an example of somebody that's invested in the last few years. What does that process look like? How does it look like in terms of just updates and progress? Like how would you kind of explain the process?
Yeah, I mean, the great thing is over time, things can change, markets change, right? For example, if you would have asked me a couple of years ago, what's my favorite investment? I would have said turnkey rentals, because I could be hands off and still make at least a 12% what they call a cash on cash return, meaning that my profits give me a 12% return on my money. That doesn't include any appreciation. It doesn't include the fact that the renter's paying down my mortgage for me. It doesn't include the fact that I get tax benefits where I pay almost no taxes on that money. All that stuff, right? Like, I mean, like some of the properties I bought, just like one I bought 5 years ago, I've made over 300% return total on that property, you know? Even raw land I've bought in the last few years, and 350,000 is now turned into about 8,300 a month, you know, about 100,000 a year, you know. It's been awesome. But now in today's market, I probably wouldn't do turnkey rentals as much. Now I'd be more lending my money out to other investors and things like that to get double-digit returns where I can be very, very hands-off, let them do all the work, and I get paid. So that's the thing that, you know, when our clients get in, they might get in with certain strategies that work great then, but then as time goes on, they realize, you know what? Hey, maybe we shouldn't buy more of these kind of investments. Maybe we could look over here instead, where there's better market, less risk, and do that. And that's where they make their money.
So the example that you mentioned of buying a property and getting the 300% returns, was that you personally, or you in a group or syndication, or how did that one specifically work?
It was a partnership. Yeah. So they do all the work. I'm a 70% partner because I supply the money. They're 30%, but they do all the labor that goes along with it. So they're helping buy and sell, transact raw land, and then turning around, and we do what's called seller financing. We're kind of like the bank, right? When you go to the bank, you ask for a mortgage on a property, you have payments you got to pay to them over a certain amount of time. Same thing, just much smaller, right? Because these properties might only be $5,000 or maybe $20,000. And so they can pay me over the next 5, 10, 20 years on monthly payments on that money with interest.
So obviously this is different than your typical regulated, mutual funds or index funds or
Mhm.
whatnot. So you connect, so a Money Ripple get into your program, get connected to a different variety of different opportunities.
Mhm.
You provide the cash, they invest it into a opportunity, and then what happens after that in terms of getting your cash back? Obviously, it's different depending on the
Yeah.
deal. How's that work?
Yeah, it always depends on the deal, right? Like if you go and buy a rental, you know, you get the cash back, you know, when you sell it, right? If you put your money in, say, a certain type of partnership or whatever, like for example, a lot of times people, if they have an apartment investment, they're going to probably hold on to that money for 5 to 7 years. Yes, they'll be paying you throughout the whole time, and then when it sells, you get a share of that ownership and those profits that come back in. But then it's probably about that time when you finally get your money back there. There's other things like for example, there's some of our clients that say, you know, I think there might be a lot of opportunities in the next year or so. I don't want to get it out long term. What can I do? Well, you can do short-term lending, where again, you lend your money to an investor, but maybe it's only for the next 6 to 12 months, and might be on a very specific project that they're doing. Often when they're renovating a property to then turn around and sell it, like a fix and flip, you know, those kind of things. That's a good example. So, you know, I had somebody today saying, well, I might need extra cash because if the interest rates keep going up and I'm looking to upgrade and buy a bigger house in a few years, I don't know if I want my money locked up. Okay, great. Well, then we do short-term rentals in the meantime, right? Even for my clients that want to get on that raw land partnership list, they can do the same kind of partnership I did, but it's a 2-year wait list. So what do they do in those 2 years? We lend their money out, right? You get their money to lend out and get on specific deals. And by the way, you get on those deals where you're actually on title, just like the bank is. So if someone like if you stop paying the bank on your mortgage, they take the property from you, right? You can do the same thing if somebody like an investor doesn't pay you, you take the property, you know, and that property has equity that where you probably would make more than your money back. So there's safeguards, there's guardrails in place to protect your money more. And so that's what some of my clients will do. They say, well, you know, I've got some time, but I don't want to have it locked up long term. Let's do this. And even there's even certain funds that some of these investors will do where they might even have one of our contacts. He has a 90-day, 9% a year fund. So he says, hey, you can get access to it after 90 days. After you request it, you'll get your money back, you know? And so every 90 days you can renew it or take it out, make 9%. So there's always options. There's always things you can be doing depending on the time frame, and that's kind of how we help, right? Because we really want to make sure that, you know, because there's so many options out there. We try to narrow the options down based on your situation, your goals, and what you're trying to accomplish. Narrow that down. So then instead of talking to 20 plus different investors, you might talk to maybe 4 or 5 different investors that might help you with your money.
If it's okay, I kind of want to throw an example at you and ask
Yeah.
you a question. So, and this happened to be somebody that's a friend of mine that I've known for over 20 years. And, they've got kids that are going into college and they live in a nice house and they've got a really good interest rate on it. And they've got good amount of equity. And it's like, okay, well, do I sell the house, get a bunch of cash, then I can pay for college and do a bunch of stuff and just have, you know, no debt and, then have the cash and put it into T-bills and get 5%.
Mm.
Or do I keep the house, live in it for longer? Because in the first example, they would be paying rent somewhere. Keep the
Mm-hmm.
house and live in there longer. And then who knows? Maybe they get a different house down the road and then keep it as a rental property. And then you're continuing to build equity over time. And
Mm-hmm.
asking me for my advice. And my job really is to kind of help map out the data and what does the data look like over a period of time and just kind of guide and help make a decision.
Yeah.
But in that scenario, you've got this imaginary equity that can either stay in the property or liquidate and then do something with it. I mean, a T-bill, like you may get 5% today, but in a year it could be very different. So like, how would you
Yeah.
advise or guide somebody in that scenario?
Yeah. And T-bills, they just don't pay enough to really move the needle that much for a situation like that. Um, I mean, it would help, but it's just not a lot. But it depends because I actually had a conversation with somebody about this very subject today. And it kind of depends on the situation because here's the two big situations you can have, right? Do you love it or leave it? It's kind of like the HGTV show that you have there, right? Love it or leave it. Do you keep it? And like you said, could it turn into a rental, especially when it got that low interest rate? Well, it depends on where you live because a lot of the hotter markets, like if you're living in the western half of the United States, you'd probably be better off selling it. Where somebody's more in the Midwest or Southeast, keeping the property may not be a bad idea if they're going to try to rent it, if it could be a good rental. If it's too expensive, then it may not make sense. It really all depends on the numbers, right? And so the thing that we look at is really, given the situation, what's going to give you the biggest improvement in your cash flow month to month, right? So if it means turning that house into a rental, buying something else, okay, cool. That could be. Or is it better to strip the equity out by either refinancing or selling that property? I'll tell you more recently, at least when people have investment properties, almost every time I encourage people not to refinance, not to pull equity out with a HELOC or anything like that, and just sell the property. And the reason being is that often what they call return on equity is the big thing to look at. To give you an example, I had one client where he had his own house that he had a lot of equity in, and he had an investment property that he had a lot of equity in. His goal was to pay off both houses and be totally debt free and then just live in life eventually. So it was going to take him 6 years to pay off both mortgages. And so I ran that scenario. I said, well, okay, your personal house, let's say we don't touch the equity in there, even though we had a lot of equity there. But let's look at this rental property. You've got 700,000 of equity in this rental property, but how much do you make per month after you pay your bills? He said $200 a month. Okay, well, what if you paid off that mortgage? Well, it'd go up to $2,400 a month. I said, you realize even at $2,400 a month and $200 a month is horrible. That's like a 0.3% return on your 700,000 of equity. What if we sold that property to strip that 700,000 of equity out and invested it elsewhere? But he was so scared and emotionally attached to this property because it was like their first rental property, right? It was like their baby. And so he didn't want to do it. It took him 2 years. But I told him, it's like, listen, that 2,400 is not worth it because that's still not a very good return on your money. It's like 4% return on your money. Sell it. Well, eventually he finally sold it. He just gave me an update a couple months ago. He sent me an email. It says, Chris, guess what? I'm now at 8,500 a month of cash flow. I bought with that equity. I've now bought 6 properties in the Southeast US. And he's like, man, I was like, I now get what you were trying to say. He's like, at first I had a hard time because he was so hyper focused, like Dave Ramsey focused of just pay off your debt. And then that's it. Like that's the game. And then just save a lot of money. But when he realized, no, that equity can actually work harder for him and make a better return, it made all more sense. And so that's what we really weigh out is do you, like you said, sell that house, but then you still have to pay rent? Well, the equity that's in that house, could it still pay your rent and then give you some more money, right? Is it
Mm-hmm.
still make you cash flow better positive than you would just in your current situation? That could be improvement. Could you strip the equity out? Could you do a home equity line of credit, which lately we haven't been recommending as much because they're high interest right now, but sometimes it makes sense. I talked to a guy today that he's trying to pay off his house in 10 years. So he's being too aggressive with it. I said, what if you refinanced to 30 years and took out the equity? Your payment would hardly even change from what you're paying right now. But now you've got, say, a couple $100,000 you can invest and make a couple thousand a month. That's a big difference. That would pay for your mortgage and then some. It'd be
Mm-hmm.
almost like being debt free. So it just depends on the situation.
So real quick, if somebody wants to reach out to you with some questions and learn more about the platforms and what you guys do, what's the best way to get a hold of you?
Yeah, you can always go to our website, moneyripples.com. And we've got lots of great education there. You can always reach out to us. And you can also follow our podcast, the Money Ripples podcast on YouTube, iTunes, wherever you consume podcasts.
What would be an example of one of the most recent episodes in terms of just topics or content from the show?
Good question. What the heck did I talk about?
Because
Okay.
I have, yeah, go ahead. Because
Yeah,
you're on
one of the most
episode
recent
760, I think. Is that right?
that you're seeing, yeah, we're like 760 something now, right?
Yeah,
Um,
yeah,
yeah, I
that's
mean, well,
massive.
when's this air?
December, January, something like that.
Oh, I'll just talk about the one that I'm about to record today then.
Yeah, yeah.
Yeah. So one of the more recent episodes, I found an interesting study, which doesn't surprise me at all, but they found a study that people that got ahead financially, even in retirement, even though it's more traditional, it wasn't about the strategy they picked. It was about their mindset and about how optimistic they were and that kind of thing. They actually became better savers, had better results just because of their mindset. And so it was shocking, revolutionary for this study they did on like over 5,000 people. For me, it was like, well, duh, we've been teaching this for years. Like mindset is huge when it comes to getting ahead. In fact, everything is about mindset. The strategy is actually easy. It's the mindset and the principles, learning and mastering those. That's the tough part with money.
Okay. I think this is a great opportunity to maybe dig deeper because, there's somebody that I follow, Alex Hormozy. One of the things he
Mm.
talks about is, people don't need more teaching. They need more reminding. The
Yeah.
information, it's there. It's just which one do you use? How do you use it to use it consistently? And, you're not going to see results right away on the things you're working on. It's going to take time. So like mindset, more important than strategy. Can you share a little bit of an example or what do you mean by that?
Yeah, I like that when he talks about repetition because that's why you don't just read the Bible once, right? You're like, oh, I mastered it. No, you didn't. Like, you're going to pick stuff up as you progress and walk along your path, right? Well, the same thing here. One thing that would just change my life, right? As I was starting to meet with the guys that were like actual real estate investors, and I was getting away from that old school financial advising type of thinking. I realized that one of the biggest things is the difference between scarcity and abundance in your mindset. Understand that spenders and savers both live in a world of scarcity, and they can never, whatever they do, it's never enough, right? They can never be free, truly free in their minds, because I've had clients that have actually gotten to the point where they could be work optional. They could quit their job today, but then they're saying, yeah, but I'm scared to. Well, that's a scarcity emotion, right? You got to address that scarcity that's preventing you from having that full level of freedom. Well, that's very true as well. And so when I started to learn that the world is not just a win-lose scenario, like when I was I worked as a mortgage broker, I would try to cut back my mortgage fees so that people would want to use me. So I'd be the cheap guy, right? But what I found was that when I started charging the standard 1% origination fee, funny enough, people were happier and they actually sent me referrals. Where before, when I was trying to be the cheap guy, they wouldn't send me referrals. And half the time they wouldn't do business with me because they'd find somebody cheaper, right? And because I was not world of scarcity, I thought I had to lose for somebody else to win. So as a financial advisor, that's pretty tough because if you want people to make more money, you just say, well, how do I not get paid? But it doesn't have to be that way, right? There are ways you can actually have them earn more and you can make more too. But unfortunately, in the financial advisor world, it's always a zero-sum game. There's a winner and a loser, never a win-win. And so like in business, and you know this, in business, the best way to win is to create the win-win. How do you help people get what they want? And as you help others get what they want and create value for them, solve problems and create solutions and serve them in ways, that money is just a natural byproduct. You never have to worry about money, which is ironic because you're not focused on you, you're focusing on them. So just taking that kind of abundance mindset, it's more than just optimism, right? If I were to continue on with that study set, it's more than just that. It's really about realizing that there's more than enough resources, more than enough of everything that we want in life. It's just a matter of, can we see the opportunity? Can we see those resources and then use them as wise stewards of them? And that's how you truly prosper.
I absolutely love that because it kind of filters into one of the things that I've been kind of working on a side project where
Mhm.
you're literally create value out of thin air. And
Yeah.
this is the example. Like, okay, I've got a home in Destin that's a short-term rental. And I've done a couple workshops down there, and it costs money to put on a workshop, and it costs money typically for people to go down and learn stuff and go stay at a home or a hotel or whatever. You got to pay money to go lodge. And I set this up where, okay, you're going to go spend money to get this experience. We're going to teach you how to then make money with XYZ. Now you're going to go
Mhm.
make money, which is then going to go filter onto the next thing. And this velocity of money is being created out of thin air. And it's like, if it's just a cost, the scarcity mindset, then it's just a cost.
Mhm.
And okay, it's not going to make sense. But like, what if we can teach you then to use this experience to then go generate more income? And then it's a win-win for everybody. And then it continues to flow through. And I love that because it doesn't have to be a zero sum scale. You can
Yeah,
create something out of nothing.
it's true. Well, like it's the same way I view business with ourselves. Like if people want to hire us on the consulting side, you know, to get one-on-one help, I mean, they'll pay us thousands of dollars, even into the tens of thousands. But we'll never take them on as a client unless we know for a fact we can help them make usually about double or more than what they pay us, so that they still make a net profit, you know, that first year. And but it's funny because some people are like, "Ooh, well, that's expensive." Well, you realize if you go to a financial advisor, say you drop 10 grand, you know, for them to invest, you would be thrilled if they made you $1,000, 10% return. 10% return. I'm talking about a 200% return, right? So it depends on how you view it. Is it a cost or is it an investment? You know, what is
Mhm.
it to you? And you know, that's the difference. Like that's the difference in perspective. Like people in scarcity will focus on cost and price, while those in abundance focus on value. Like, what do I get for that price? Right? They take it a step further. They're the ones that say, I'm not going to buy that $20 Oster blender because it's going to break in 2 months. I'm going to go buy that Ninja or the Blend Tech or whatever it's going to be because I know that thing's better quality and it'll last longer. And it's just a better value for what I get for the money. That's just one of many ways that you should be focusing on when you're looking at money when you're trying to stay in abundance.
So let's say you got somebody that's listening to this and they've got a job and they've got a 401k and they've got no real estate and they're all 401k heavy. And maybe they have the ability to, leverage some, not leverage, but they have cash saved, or maybe they can borrow out of the 401k or whatever. They've got 50K that they
Yeah.
have to work with. Is that a number that can be leveraged or utilized through your platform to be able to go find some more returns?
Technically, yes. Although I probably wouldn't recommend it. And the reason just being because there's not a lot of investments you can do with just 50,000. And if you have to borrow from a 401k, that's even worse, right? If it's like a current company 401k and you can borrow that 50,000, you're gonna have to pay back about over $900 a month. So it's very hard to get an investment to pay you that much money. It's like you'd have to get like a 24%, 23% rate of return on your money. It's kind of tough. You could do it, but you'd probably be not very diversified. You'd be in just one deal and that's it. So you're kind of banking on everything. I generally recommend if people are going to try to really diversify appropriately, they need at least 150,000 to play with. And yes, if you have an old 401k or an IRA, you can still keep it inside the IRA, but then invest in all these types of investments I talked about. You just don't do it with the typical financial advisor. It's done differently, but you can actually still invest inside of an IRA. So if you've got, so people that generally have at least older 401ks or IRAs that they have around Roth IRAs, money sitting in savings or even like life insurance, you got money in there. There's things you can do with that. Sometimes, like I said, not so much equity, but if you have investment properties that maybe have a lot of equity, but you're not making a lot of money in return, there might be some things we can do to rearrange the money that you have to get it to pay you more money.
Okay, that helps. So that kind of gives an example. Okay, if you've got that $1 million example in the Fidelity account in a 401k, you've got a rental property that's giving you barely any income.
Mhm.
Maybe one idea could be, okay, we sell, liquidate it, and then go get more returns through these alternative investments and then diversify it within the 150.
Mhm. Exactly. Yeah,
Cool.
like I talked to a guy today, had $200,000 to invest, and I said, "Well, that's great. You can still diversify and do some things, where like one of the funds we talked about, it pays 1% a month. So if say he did 100,000 that fund, that's paying him $1,000 a month. There's some other funds that might pay between 10 and 12% as well. He can diversify, but still get paid at least, really 20,000, to 24,000 a year just on that money alone. Just getting it to work harder for him."
So somebody that's 22 years old
Mhm.
and they're out there, they just got out of college, they're going to get a job, they're making an average wage, just say $20 an hour.
Mhm.
What advice would you give to them right here, right now, where prices for everything are skyrocketing, rates are high? What advice would you
I would
give?
give the advice similar to what Warren Buffett gave about a year or two ago, which is kind of the same advice I've been given since, especially since 2020, is really focus on figuring out how you can create the greatest value possible, right? The other thing to understand, that principle that always works, is that dollars follow value. The more value you can create for somebody by serving them, solving problems, or adding value in any way, shape, or form, that essentially allows you to reciprocate money in return, the better, the more skilled you are, the more skills you can develop that help in doing that. And it's not just any skill; it's skills that actually help people. You can you can do basket weaving all you want. That may or may not make you money, right? So it's got to be something that people really perceive as a something that they need, right? Helping get people what they want, you won't really want anymore. That's what I've noticed. So focus on that. Get your income higher, because that could be your best investment right now. And the great thing is that it doesn't require any money to do it. Usually, often the best investments don't require money to make money, but they might require your time and energy to then develop more and get that wage up. And in fact, I had a guy that was making $15 an hour a year and a half later, just by asking his employer. He just went to him and said, "What can I do to serve the company or help the company that would merit me a raise, where I can earn a raise?" He didn't say I was entitled to it. He said, "How can I earn a raise?" And he went from $15 an hour to about 28, almost $29 an hour in a year and a half, just by asking that question of his employer over and over. And he would do it, and they give him a raise, and he'd do the next thing. Then they gave him a promotion because he kept doing that. I've had another client that worked at a big, large bank, did the same thing, had 100 people competing for the same position, the same two positions. He got it. And when they called him in, they said, "We didn't give it to you because you're the highest performer, because you weren't. We gave that to the first guy. But we gave you the second position because you were the only one out of over 100 candidates that asked us what you could do to earn that promotion. And because of that, we remembered you and we were impressed. And so we gave you the job." Gave him like a 3,000 or 4,000 a month increase in his pay just from that one thing alone.
That's badass. I mean,
Yeah.
because like it's an obvious question to ask, right? But like
Mhm.
sometimes you got to get out of your own way to open up your mind to the possibilities and have that mentorship to to get out of your way. I absolutely love that. Get the blueprint, put it on paper, execute, boom. Um,
Yeah.
one of the things that like I've been talking about personally is that home prices over the last 30 years have quadrupled in
Mhm.
terms of the average price, and median income based on the data from the Fed. The median income charts for 30 years, they are inflation adjusted, so it's not always kind of one to one, but like the median income's like 52,000 from 30 years ago, and now it's like 72. Or it's gone up like 25 or 30%. Hasn't gone up much. And it's like the
Yeah.
barrier to entry to be able to purchase real estate as a primary residence has just gone up so much in terms of prices, the money that you need. And it's like, you know, one of the videos I've been working on today, and this is 11/28. You know, the World Economic Forum, I think in 2016, put out a quote of, "You will own nothing and you'll be happy." I'm not sure if you've seen that or heard that, but like
Uh-huh.
I don't have all the context in front of me in terms of the entire conversation, but that's stuff that I keep seeing online a lot. And it's like, you will own nothing and you'll be happy in terms of the resources out there and the population growing up. Well, all the things that are going into this. And it's like
Mhm.
in 10, 20 years, if prices keep going up and wages remain stagnant, you're going to have a generation or two of people that aren't going to own real estate. And that's kind of scary to me. What are your thoughts on that?
There's you can't deny the facts. I mean, we have the lowest home ownership, especially among the younger generation now, than ever, right? And it really does come to that point. And one of two things is going to have to happen. right? Everything has to come back into balance. So either one, what's going to happen is that more people are going to rent, but that will drive rent prices up more, or two, prices may have to come down. And the only way that the prices could stay elevated is if people's wages go up. And that kind of happened in 2020, right? Like we saw between 2020 and 2021, it was like they were just trying to keep people from quitting, because the government was just throwing money at people. Well, that's not happening anymore. So wages aren't really going up much this year because of that very reason. And it's even worse if you make more money. The more money you make, the less of a raise you got. So don't think that making more money is going to make it better, because sometimes it may not. Like, yes, going from 15 bucks an hour to 20 bucks an hour seems amazing. But if you're higher level management, you barely saw a difference in the last couple of years because of that very reason. So yeah, I think everything will come back in equilibrium one way or the other. It either means that inflation's got to go skyrocketing, like you kind of mentioned earlier, or two, prices got to come down. It's one of the two is got to have to happen.
Okay. So which one are you betting on?
I'm betting on that. I think some parts of the country you'll see prices come down with real estate. It's already happening. I mean, like Austin, Texas, where my father-in-law lives, that was one of the hottest markets. It's now depreciating, right? So there's some of those markets doing that. I think part of it is also helping too, is because of that ability to do more virtual, right? Doing things through Zoom. People are able to sprawl. There's that urban sprawl that's now going out to the suburban or even to rural areas where it's cheaper. So you're going to start seeing some of those areas doing better. That's why some of the real estate I'm looking at right now are more in rural areas than just even suburban areas too. And I think too, it's possible as well as that there could be interest rate adjustments to where it can make it more affordable again. I'm not going to count on that though. So I think wages will go up with a combination of a little bit lower of real estate prices, but I think there will be some markets you won't see much depreciation. It'll maybe more hold flat. So one warning I've given a lot of my clients or one-on-one clients is to not bank on appreciation the next 3 to 5 years. Like I really do think that I think prices are going to level out a little bit more. There might be some certain pockets that you'll see some appreciation, but I think for the most part, you're going to see it level off.
Going back to the quote from Warren Buffett, dollars follow creating value, solving a problem. If you're 22, 25, 35, whatever, and you're looking to be able to find new skills, build new skills, generate more income, whether it be a side hustle or a side business or replace your current job, are there any sectors or niches that you feel like could be something worthwhile putting some time and resources into building skills?
Well, that's a good point. I'd say this. I'd say that the one I've been telling my kids is if they're handy at all, I think the trades, like anything like handyman type stuff to building, those kind of things. Like there's so many people aging out of it right now, right? Like I know that, even in education, like teacher space, that's happening as well. Nobody wants to be a teacher anymore. So like there's a shortage of teachers, and that you might see some benefit there. Problem is they have unions and unions suck. So usually that means they won't get paid much more because unions are too dang expensive. But I think definitely like in the trades, where it's dealing with building and more the manual labor. There's too many people in the younger generation thinking, well, maybe I can become an influencer or a YouTuber, right? And the truth is, you're not. The odds are stacked against it. That's not going to happen. And but definitely, I think there's there's a lot of trades that people are retiring out of right now and not being replaced with, and I think that's one of them.
Yeah, I love that, because at the end of the day, if you can combine that with maybe an additional skill as well, like
Mhm.
I know we just interviewed a guy, Nick's All Improvement, all was it All Around Improvement is the name of his company, and he's
Mhm.
been in the field for a long time. Helping other investors build and rehab properties is like, okay, well, people coming in like, you're a badass at what you do. Why are you not doing this for yourself? And it's like,
Uh-huh.
okay, well, maybe I can. Well, what's the biggest limiting factor? Well, I need the cash. Okay, well, let's put a plan together, figure it out. And then all of a sudden, he's doing within about a 2 year span. Now he's doing 9 at a time because he knows that part of the game. That's the hardest thing to figure out, in my opinion,
Yeah.
is the labor that's going to show up and do a good job. And combine that with finding the good deals and et cetera, et cetera. Like he's able to purchase properties above the wholesale prices that are listed because he can make up for it because he has his own crew. He can
Yeah.
find this value and synergy. So it's like every situation is going to be different. But yeah, I love that because yeah, it's not being replaced.
oh man, if you can have a good crew that actually shows up to do the job when they say they're going to do it, you already are winning. Because man, I mean, we hire people all the time. I'm not a handy guy, and people think, oh, you must be good with technology. No, I'm not good at that either. Like I'm really just good at this particular thing. But man, like when it comes to handyman type stuff, like if you can just find somebody to show up, it's amazing how you're hired. You're good. Because I would say at least 2 out of 3 contractors we hire don't show up to do the job. So if you want to stand out, even if you think like the whole game is like it's already overpopulated or over, which is not oversaturated at all in this realm of building and carpentry and things like that. The truth is that if you just actually show up and do what you say you're going to do, you're already leaps and bounds ahead of everybody else.
I kind of want to back up for a second and now we're running out of time here. But
Mhm.
you left the financial industry to kind of go down this path and build something out of thin air, out of scratch.
Yeah.
What was going through your brain to tell you that this is possible? Like that wasn't even a thing back in those days. So how does it even come together?
You know, I mean, for me, it was a little bit of faith, I guess, because I mean, for a few months, like when I was I had my foot in both worlds. It was kind of like I had the blue pill and the matrix red pill at the same time. I'm like, which one do I take? I finally, picked the right pill, and I left being a financial advisor when I realized that I couldn't keep teaching a lie. And so I followed my integrity. I followed my gut. I followed where I could stay in alignment with who I was. And I was a little bit lost because I mean, I stayed on as a mortgage broker. So I did that. I thought, well, I can't lie with mortgages at least. And then I was even teaching ballroom dancing on the side. And then on top of that, I was even doing stock coaching. I was teaching people how to trade stocks and options. All the meanwhile, I'm trying to learn about real estate and passive income and like really like how do I actually apply the things that you hear about in Rich Dad Poor Dad, but nobody ever really teaches you. Even Rich Dad Poor Dad doesn't really teach you how to do it right. And once I really started to get that big epiphany of like, oh, this is about passive income. How do you get that to generate income for you on a regular, predictable basis? All the meanwhile, as I'm getting my money working harder for me, I got to the point where I said, holy cow, I'm looking at the numbers. I could quit stock coaching. I don't have to do that anymore. I can just lay that to bed. In fact, everything I was making there was just gravy. That was just helping me invest more. So I guess, long answer to your question. I mean, for me, it required a lot of faith because at first I was excited, but I didn't have any money to prove it. Even when people ask me like, how much more money you made? Nothing, but it's awesome. Once I started to really learn how to apply it and make it work, then the money started coming, the very thing that I expected anyways. So I think that was the big thing for me was just switching my mindset, getting away from what I was taught as a financial advisor, waking up to reality of what I actually can see is real and happening. That helped me shift and have greater faith in what I was doing.
Those early days when you're going down this path and, obviously it's going to take time to get those results that will exceed the typical return. What are
Mhm.
some of the resources or people that were helping you along the way, whether it be advising or encouraging or what was going on in those times?
Yeah. Well, I was listening to an AM talk radio show at the time with real estate investors. They've since passed on, so they're not around anymore. But I mean, a lot of it was just like, I was listening to talk radio, which is kind of the equivalent of podcast today, right?
Mhm.
So I mean, I was listening to people that were teaching stuff. And I'll tell you, like, I don't really listen to like Kiyosaki anymore. Robert Kiyosaki that wrote Rich Dad Poor Dad. He's kind of said some he's getting kind of loopy right now. He's getting
Yeah.
older
Yeah.
and he's saying some pretty crazy stuff that I'm like, I don't even know where this guy's coming from. Even and I get what he's been talking about for years, and I've been doing it, but I'm like, this guy's out in left field now. Nothing, I'm sure he's a great guy, but I just stopped listening to him. Honestly, like, there's not a whole lot of people I listen to right now. I more go with what I've learned and what I've learned over the years. Now, I do join mastermind groups, like I'm in real estate mastermind, so I can understand what's going on, the different markets and things like that. But for the most part, like a lot of the things that I'm teaching from experience. Just the things that I've learned and done and was able to experience myself, and then I can teach from that because I can't teach something I haven't done. I'm a crappy BSer. So
So, how many different markets do you have your eye on or pulse in terms of geography?
I mean, it's pretty nationwide. I've got buddies all over the country in all different parts, and if they're like in Phoenix, which I even warn people, like, don't get in the Phoenix market. Like, everybody's going in, like, it's the time to get out, right? And I'll tell you, that's another thing I've learned too. I mean, even just watching these people, but also, like, whenever I hear something is hot, like if everybody's saying something, or everybody's saying something in the media, or even the common person saying something, I do the opposite. Whatever I hear saying to the public or in the media, I do the opposite of what they say. If they think that real estate's going to tank, I buy more real estate. If they say, like last year in 2022, everybody's saying, don't hold on to cash, you'll lose to inflation, I started holding on to more cash.
Mhm.
And which, by the way, Warren Buffett's been doing that too. He actually has added another 32 billion in just the last 9 months to his portfolio. 32 billion in just cash sitting around not invested. you know so I've been doing the same thing he's doing. So that's the thing, is like, when you really start to listen and what's going on. This is why I didn't buy NFTs and a bunch of crypto. I sold my crypto last year when I was at a height, because everybody was saying, when I knew, people that were I went to high school with that don't know anything about money, saying buy crypto, that's the time to sell crypto.
Yeah.
If that makes sense. So whatever the masses tell you to do the opposite.
Okay. So I'll give you an example of something that I did for a client. So I had a client that's in, called Northeast, New York, New Jersey area. Too expensive to buy a duplex there. Wants the house hack. And it's like, okay, well, the rents just don't, even if I live in it for a year and then, move out and have it fully rented, it doesn't cover the payment. It just doesn't make sense.
Mhm.
Well, what if I just go outright and buy an investment property? So instead of like 3.5% down on a primary, you're talking about, you know, 20% down on an investment property.
100%.
So we
Yeah.
were looking at different markets. One market was Pittsburgh. The other one was Wilmington in North Carolina. And the other one was Allentown. And of all those three
Hmm.
areas, Allentown was the one that cash flowed the most by pretty substantially amount.
Yeah.
And, those are types of examples where I've done, comparing different markets for out of state investors. And,
Yeah.
that's just one example. But is there a certain market that you're okay throwing out there that could be attractive from that respect in terms of just opportunity or cash flows?
Yeah, I mean, I've been looking more in the southeast. There's definitely opportunity in the Midwest for sure, and that even includes southern PA, right? I mean, there's definitely some opportunity there. I've been looking more like in the like North Carolina more recently, because they haven't. Nobody talks about North Carolina, which is why I kind of like it better. Texas, I mean, obviously is had some good times, but I'm very wary of Texas because everybody want to get into Texas. So if everybody says that they want to get into something, I typically stay away. I'll tell you, I mean, I've done Alabama. I would probably not recommend Alabama, even if the numbers look good. And maybe it's like some of my experience, even with like Southern Pennsylvania too, right? Where like it could be good, but sometimes the renters aren't great. Like it depends on who you really get in there. Plus, if you need good property managers, you got to make sure you have somebody really good in that area. But again, like I've been looking more like the Carolinas. I think Georgia's got some good opportunity too. There's still some good growth, and even in like, I mean, even though I would say it's on the back end side of starting to get more hot. Places like Arkansas, Oklahoma, even places like that are some pretty interesting markets that have some strong employment, and they really haven't overinflated too much.
So kind of coming back to your platforms and kind of overall vision as the platforms continue to grow, you're over, 700 episodes in,
Mhm.
um, got a client base that's growing. What are some of the next visions or goals for all that you're doing?
Yeah, I mean, my next vision is really just keep expanding my ripple effect, right? I mean, that's the thing, is like I am still work optional. Like I tell my team all the time, and I try not to freak them out by it. I tell them, like, I could quit, I can shut down this business anytime I want and be fine, at least for my family. In fact, honestly, my life would be simpler and easier if I did. But I really feel like God has blessed me. Like I feel like I've been put in this position. I have these resources, the money and time and abilities and talents that I can use to help bless other people's lives. And so for me, it's always about expanding that mission that we have with Money Ripples, that ripple effect that we teach even our own followers. We call them ripplers, right? The people that follow our podcast. We want them to create their own ripple effect. We want them to get away from living in survival and away from just trying to, pay their own bills and focus on themselves, to start to know that their needs are met. And then they can look at other people and how they can help bless their lives too. And that's the thing. The more you prosper financially, the greater capacity you have to bless more lives. So that's really our mission. That's our mission to do that. We want over 1,000 families financially independent by 2030, with the people that we've been working with and things like that. So that's our real vision, is just to keep taking it to that next level. Heck, even on the infinite banking side, I mean, we've been revolutionizing that industry too with life insurance, because honestly, most people out there, even the ones in the real estate game, are overcharging you so badly that we're just like, well, we can't refer anybody to them because we don't trust them. So we got to do it ourselves. And so we've even been trying to create more competition so that the others that have been overcharging will listen and start to bring down their costs too.
Wow.
So that's the kind of thing that we're really here to do, is just do what we do best, and to serve people and help them to have a greater ability to bless more lives.
That's awesome. That is awesome. I mean, we're obviously coming up on time here, but I can't wait to dig in more to your show. There's just so many good guests on there, and just flipping the script of what we expect, what we hear from mainstream, and just uncovering what's possible when it comes to finances and getting ahead and financial freedom. So, thank you so much for spending time with us today and sharing some of these stories and insights. And can't wait to catch up more of the podcast as well.
Thank you so much.
All right. Thanks, Chris. Take care.